$12 trillion. That's how much private equity is projected to manage by 2029. It's a staggering number, but the real story is what's behind it. Firms expanding into infrastructure, secondaries, private credit, and redefining how they build teams, structure the deals, and create value. If you work in or around private equity, this is a moment to pay attention. Explore our private equity content hub for insights, research, and tools to keep you sharp. Visit cfainstitute.org/PE to browse the collection.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we're fortunate to have with us Eric Van Nostrand, Global Head of Markets and Chief Economist at Lazard Asset Management. Lazard Asset Management is a global investment firm, approximately $250 billion in assets under management. Eric has deep expertise in both the public and private sectors, spanning from Washington to Wall Street. Prior to joining Lazard, Eric served as the Assistant Secretary of the Treasury for Economic Policy. In that role, he was the recipient of the Alexander Hamilton Award, the highest honor awarded by the Department of the Treasury. Previously, Eric was also a Managing Director and Head of Macro Research and Portfolio Strategy for Multi-Asset Strategies at BlackRock. Eric, welcome to the podcast.
Thanks, Gary. Good to be with you.
No shortage of topics really for us to unpack today, Eric. Let's start with your assessment of the current state of the U.S. economy.
I had to give you a short answer on the U.S. economy, Gary. I'd say that the U.S. economy today is marked by cyclical strength, but an awful lot of structural challenge. I think probably the biggest challenge facing investors in the U.S. economy right now is a recognition that over, basically my entire adulthood, over the careers of most people working in markets today, U.S. investors have been focused on demand management. How is monetary policy and fiscal policy going to keep demand strong enough to recover from the GFC, to recover from COVID, to recover from the European sovereign debt crisis? We're at a point now where, following the recovery from COVID, demand from households and consumers remains cyclically very strong. But we're facing a new set of challenges coming from the supply side. On the upsides, we're focused on the strong contributions from supply, from our ability to produce from the artificial intelligence developments of the last couple of years. But we're also facing challenges on the supply side as evolving tariff policy and our evolving international economic policy constrain the flow of capital and the flow of economic growth across countries. So some of the conventional challenges we're all used to in the U.S. economy, how do we get companies hiring and investing? Those challenges aren't as acute anymore. But the supply side structural challenges that are going to hold companies back from investing in the long term are the new things investors need to reckon with.
And this week, we're faced with an issue we've been faced with before, the shutdown of the government. I mean, how should we be thinking about this? The markets continue to churn higher. Is that just one data point along the way, or is that something we should be sort of concerned about longer term, given your reference to U.S. fiscal policy?
Yeah, I think the important thing to keep in mind here, Gary, is there's a short-term impact to the government shutdown, and the conventional wisdom there is that markets always tend to look through these shutdowns because they tend to be temporary. They tend to avoid disrupting the more important short-term growth impulses that typically animate markets. So investors tend to shrug when these shutdowns happen. And if you're just thinking about what the stock market's going to do over the next couple of days, shrugging is a reasonable thing to do. But that, I think, really misses the broader long-term signal here, which is that the polarization in Congress has created a situation where the determination of fiscal policy in the United States is likely to get more and more fraught, as it has been over the past couple decades. That's created a situation where our fiscal policy is mathematically unsustainable, in the sense that the interest costs that we use to service U.S. Treasuries is going to play a historically much larger. It's going to consume a historically large share of our GDP going forward unless we do something in the near term. And those fiscal tensions are just going to get worse for bond investors, and they're going to create more uncertainty for equity investors. So even though I don't think there's a significant risk of near-term market disruption from this instant shutdown, what it's emblematic of, the dysfunction in Washington that leads to persistently unsustainable fiscal policy, is only going to be a growing risk in the United States.
So you do foresee possibly a day of reckoning, no matter how far out it might be?
Yeah, I think it's clear from the way bond markets in particular have behaved over the course of the year that investors are thinking differently about the U.S. fiscal picture than they were. To my mind, one of the most interesting market developments of the year is the changing relationship between the dollar and U.S. interest rates. We saw this start in March and April. Usually what happens, when the dollar depreciates, it comes alongside interest rates going down, an expectation of easier monetary policy in the United States. But what we saw earlier this year was dollar weakening that was coupled by increases in long-term interest rates. That's not usual. A lot of it reflected the tariff back and forth of the early spring, and I think in the press that's what it was largely attributed to. But a lot of that decoupling between the dollar and rates has a lot to do with our fiscal policy and the view among bond investors, specifically, and markets in general, is that the growing unsustainability of our fiscal policy means that investors are demanding more interest in the long end, more compensation to lend money to the U.S. government, and that's a worrying structural development.
What about some of the headline risks that have got a lot into play this year? You touched on tariffs, inflation, the labor market also. Is there a priority order to consider regarding how these should be factored into portfolio manager frameworks over the next 6 to 12 months?
Yeah, I think that many of those issues fit into that dynamic I opened with, the fact that we're reckoning more with supply constraints than we're used to as investors and economists. The inflation picture looks very different now than the one you and I are used to for the past couple decades, because supply tightening is playing much more of a role in the narrative. I think that investors have been desensitized a little bit in the past couple months to inflation risks. We look over the past couple years where we had, after the pandemic recovery, the first real significant burst of inflation in this country in some decades. We largely recovered from it as disinflation kicked in and shifted back down toward something closer to the Fed's target. And even though we never really got to the Fed's target, there's a narrative out there in markets that we solved that inflation problem. I don't think it's fair to say we've solved that yet. I think that inflation remains a very serious risk for investors, especially as the ongoing tariffs that we're all admittedly a little tired of talking about, but are still very much at play, will continue to increase goods prices in the coming months.
And you referenced the Federal Reserve. They recently lowered interest rates. What do you think the path forward is for them over the next 6 to 12 months?
Look, I think the Fed's job is as hard as it's been in my lifetime right now, because their dual mandate, which focuses them on both price stability, controlling inflation, and full employment, which is encouraging growth and hiring, are pulling them in opposite directions to a greater extent than has been the case in the past few business cycles. And we see that as hiring is slowing at the same time that we're seeing continued inflationary pressures. Now, my view is that most of the slowing we've seen in hiring over the course of the year, and this goes back to my broader framing, is more about supply coming in than demand falling off. And that's essentially about the surge in immigration that we saw in the years following the COVID pandemic. As that surge abates, and as the U.S. administration's policies to further reduce immigration have impact, then we should expect less hiring because there's less overall labor supply. I think that is most of the reason that we're seeing slower hiring over the course of the year. But it's not the whole reason. There's also a demand component. Investment leaders, business leaders are reporting that they have less appetite to hire on margins given the uncertainty they're seeing in the economy right now. That weakening demand, coupled with the upside inflation risks, puts the Fed in a fix, and they now need to weight these things a little bit differently. You saw with the cut they put in September that they thought the risk of keeping policy too tight and disrupting the labor market was worth prioritizing in September. But what I'd caution investors to recognize, and you can see this from the communications that Chair Powell and other Fed officials have made, is that they're putting a lot of weight on and very vigilant toward those persistent inflation risks too. So the short answer to your question, Gary, is I think they're poised to cut more as they see some of this demand-driven weakness in hiring. But I think they recognize that demand-driven risk in hiring is maybe widely appreciated in markets, and inflation risk persists. So I think they're going to cut, but I think they're going to cut less than the market expects over the course of the year to come.
We've just hit on a bunch of potential risks to the economy and things like that. And I'm just wondering, when you look at it over time, the U.S. economy seems pretty resilient. The long-term trajectory of the S&P 500 is upwards, and this has occurred against the backdrop of a lot of different administrations, a lot of challenging events. What is that? What's the takeaway for everyone from that?
Yeah, I think over the long term, and this is something I thought a lot about in government, and I think a lot about now as an investor, the idea of American exceptionalism in global financial markets and global economic growth is something that, has a lot of empirical evidence behind it. The model that we have in this country for delivering productivity gains, for distributing those gains to American businesses and households, still, in my view, remains unparalleled. And that's part of the reason you've seen this persistent strength in our equity markets, in our economic growth, in ways that you just haven't seen in other countries. Now, it's important to recognize that the sources of that exceptionalism change over time. And what we're seeing this year, most of that exceptionalism in the U.S. stock market can be attributed to artificial intelligence, given the significant bet, what my boss Peter Orzog calls a levered bet on AI by U.S. markets. It's very much a significant commitment of capital by business leaders and investments into AI. And that is really benefiting U.S. markets more so than some of our developed world peers. But last point on this is that while that exceptionalism has delivered a lot of positive returns over the past couple decades, it's absolutely true that it's being challenged today. We did see a period this year where, amid all the tariff back and forth and amid our fiscal policy developments, European markets were persistently outperforming the United States. That's backed off a little bit as the AI boom has regained steam in the past couple months, excuse me. But I do think that markets do recognize, investors do recognize that when the United States withdraws from global engagement, there are costs to that, to the investments we make across the globe.
What about the flip side? I mean, are there factors that could provide upside surprise? There's over $7 trillion in money market funds in the U.S. Can that be viewed as support for the stock market or support for the economy, or is it something different?
Yeah, it's a great question. I'm smiling because it's one we talk a lot about at Lazard, which is, I'm an economist in my bones. I like to think about things according to their intellectual drivers first. And to my mind, the biggest explanation of the stock market's rise this year is because the market's expectation of the returns that AI is going to produce for the American corporate sector have surprised to the upside in a very meaningful way, and that's delivered returns to shareholders. There's another kind of way of explaining the stock market's moves that isn't oriented in the long-term expectations of economic outcomes. It's oriented in where are the flows coming from that are driving prices day to day. And one thing we've really seen over the course of the year, and this is in some sense a reflection of, the change in global wealth distribution and the surge in incomes that we saw after the COVID pandemic, there is just a lot of new money flowing into large cap U.S. equities. And that persistent flow, and I agree with you, there's more to come given how much is tied up in safe assets, in money market funds. And as interest rates, as the Fed works to push interest rates down over the next year, the incentive for investors to move money into risky assets is going to persist. A lot of that, an economist would say, should already be discounted in markets. We should already be seeing that. And it is to some extent reflected in today's strong stock market pricing. But those flows tend to persist, and they tend to surprise markets with how much they can persist. And if those money market funds do start to, in response to rate cuts, start to see broader allocations into equities, then there's a lot more upside on the table.
And you've touched on it. The S&P 500, over 1/3 of the value there is technology. It's the technology sector, and clearly the topic of the day always is AI. Do you have a view as to how that could reshape the workforce and economies globally?
Yeah, I mean, I think this is in some sense the central investment question of our time. So I'll give you my view, but I bet my view will evolve in the next couple of weeks, and it'll evolve a lot more in the next couple of months. The adage I like that I saw on a billboard or something the other day, I can't cite my source for this, but the adage I said was, "No AI is not going to take your job, but someone using AI better than you might." And I think that's the right way to think about it, which is I think a lot of the doomsaying around massive parts of the labor force being taken out by the rise of large language models is probably overdone relative to what's likely to happen in the near term. Of course, industries are going to shift and change, and the skill sets most in demand will shift and change. But I think the market is probably a little too, or not the market, but the broader conversation about AI, probably a little too worried about those outcomes being large in the near term. But I do think it's going to change the way we work in a meaningful way that should deliver a lot of productivity gains over the medium term. I also think there's when we do kind of forecast the long-term impacts of AI, I think the easy thing to do is for people to say that it's going to take low skill wages, manual labor, and make that less higher return for humans. But as we think about the way we use AI at Lazard, the way we use AI at other companies, a lot of what it can do today is replacing a lot of what we think of as conventionally white collar, higher paid work, like doing things like legal research, doing things like preparing PowerPoints ahead of a big deal. Those are things that AI is proving itself good at. I think one interesting topic in AI that doesn't get enough attention because we're all focused now on large language models and the chatbots and how we can communicate with AI via text is the potential for AI to interact with physical technology innovations in the robotics space. We have a robotics fund at Lazard that is focused on the use of AI in physical tools, which is something where I think there's been less of the narrative has been focused, but I think that may just be the next wave of AI fervor in robotic space.
Is it fair to read in what you just said that how investment portfolios are constructed or managed, AI will have a big role in that?
I think one of our big projects at Lazard right now is figuring out the best way for AI to help us manage portfolios to structure those outcomes. But it's an interesting problem, right? Because what we don't want to do as active managers, and I'm talking less about the world now and more about how I approach my business. As active managers, you're trying to do something. You're trying to invest in a way that the consensus is not doing. You want to have an idea, you want to buy something that the market doesn't appreciate is going to surge, right? You want to do something outside the norm. And I worry about a world in which financial advisors and portfolio managers broadly are kind of getting the same ideas for AI about how they should construct returns, because the real winners in that world are going to be the ones who defy the consensus and find the things the large language models aren't pointing to. So we're doing it. We're thinking about how it can inform our investment process, but it's important to keep in mind that there is a significant risk of groupthink that comes from, a common resource on a common reliance, on similar technologies.
And lastly, on AI, how do you think about it relative to GDP, how it's measured? Did it affect longer term how we view GDP growth?
Yeah, so it's another super interesting question that we spend a lot of time on. The question of is GDP the right measure of good economic outcomes been debated for decades. There's both the distributional concern of if a smaller part of the distribution is capturing GDP, does that make sense to pay attention to? But also there are, units of happiness and improvements to our lives that we all would be very hesitant to give up that are not reflected in GDP. And AI is probably delivering some of that. But I do think, and I am very positive, very bullish on the ability of AI to actually deliver higher productivity growth. One way to think about GDP as supply side model is that it's a function both of the capital inputs you bring to the table, how many people you have, how much capital they're using to build stuff, and productivity, how good those people and capital units are at producing stuff. AI has the potential to really increase productivity, to get a lot more out of an hour of human labor. I've seen my own productivity change pretty meaningfully as I've been learning to incorporate it over the past couple of years. So I'm optimistic about that. But GDP is not going to be the whole picture for understanding AI.
We began the conversation focused on the U.S. markets. Shifting outside the U.S., Eric, what's your outlook for the developed world as well as emerging economies?
Yeah, thanks, Gary. I think the broader trend of supply constraints continuing to weigh on global growth applies almost as much to the rest of the developed world, to Europe and Japan, as it does here in the United States. And in fact, you've seen some of those long-term tensions showing up in rising long-end interest rates. That's really a global phenomenon. You've seen that in long-end European rates rising, long-end Japanese rates rising. So a lot of the challenges I just talked about, even though a lot of them kind of stem from developments happening in the US, are best interpreted as global developments, both from a markets and an economics perspective. But there's also, I think, some important divergences in Europe. In Europe, I think the ECB, the European Central Bank, their Federal Reserve, has more room to continue easing policy than the Fed does, given the balance of employment and inflation risks they have there. And that's likely going to be a further tailwind to European growth that U.S. growth might not benefit from in the near term. Their lower reliance on AI in terms of the equity market in Europe, there's upsides and downsides to that. That's part of the reason they haven't captured as much upside as American investors have over the course of the year from AI. But it also means they're taking less risk of an AI bubble bursting in the near term, and would likely see lower volatility outcomes there.
We've talked a few times about tariffs, which I think are relevant, obviously, for the global economy, but also manufacturing reshoring. Can you take those two issues and sort of, elaborate on what do you view as the impact on the global economy?
Yeah, when it comes to manufacturing reshoring, no matter who's in power in Washington, there's always been political benefits toward making the argument that we should rebuild a manufacturing sector in the United States. And I think, there's a good version of that for the economy and a bad version of that. The bad version of that is going backwards from a productivity basis. Do we really want to be the country that makes T-shirts? Probably not for boosting the incomes of American workers. And we should rely on our comparative advantages and rely on international trade to deliver those sorts of goods to us. That said, that's not all manufacturing is. What we worked on quite thoroughly in the Biden administration, and this was a big part of my role in the Treasury Department, was high-tech manufacturing, the manufacturing of clean energy, the manufacturing of semiconductors, where we think the American human capital stock can have a comparative advantage. And my hope is that you'll see those kind of high productivity, high-tech manufacturing continue to strengthen in the United States as it has over the past couple years. But I hope we design policy in a thoughtful way that will encourage that sort of growth rather than simply kind of reshoring things for sort of zero-sum domestic manufacturing purposes.
Something that's, challenging to quantify, but definitely affects the markets. Geopolitical tensions to consider: Russia, Ukraine, Middle East, U.S., China. What's the investor lens to view those through? And do you see sort of a second shoe of market impact to drop from any of these?
Yeah, I laugh a little bit when you say hard to quantify geopolitical tensions, because my team spends a lot of time. I know a lot of our competing teams across the industry spend a lot of time thinking about that question. How do we measure the geopolitical tension that we're seeing? And I do worry that in the market narrative, investors are too quick to lump all geopolitical things together under a big tensions are rising, tensions are falling type bucket. And I think you need to be a little more nuanced than that, because some of the geopolitical tensions we've seen this year have been very market relevant. Others are things the markets looked through. I think the tariffs, and I've written about this before, the tariffs stand to change the relationship between the way business investment interacts with economic growth in a way that in the long run, I think is going to be bad for corporate profits and bad for those corporations' ability to deliver growth for the economy overall. And I think corporate leaders are now thinking through, when, my ability to source inputs from other countries is exogenously more expensive because of the imposition of tariffs, how can I deliver the same value to my clients and customers? And thinking about that is going to be an ongoing, persistent challenge. These tensions are going to evolve in different ways. Obviously, if you just look at what U.S. assets have done throughout this period, it's been a very good time to hold U.S. stocks. But it's been a good time to hold U.S. stocks because of the domestic AI boom. And that doesn't mean we should be looking past these other broader risks.
There's so many inputs to the economy these days. When you do your own analysis and you try to maybe identify a turning point or an inflection point to the upside or downside, can you share with us some of the more important data points are there economic indicators that you look at?
Yeah, I think the big one right now, it's a little boring and cliche to say at the moment that, constantly gathering data on the way AI is reshaping the economy is important, but that is obviously central toward understanding um, toward understanding the way markets are going to react to ongoing developments in that space. So what we're very interested in is how are services companies using the technology in ways that are kind of changing the nature of the intellectual services that they are able to deliver to clients. And is that are those potential upsides being experienced by services companies able to offset some of the challenges that more goods-oriented manufacturers are experiencing from the global tariff and international economic policy picture?
And given the current macro backdrop that we've discussed, I mean, what are you hearing from clients as far as asset allocation? Are you seeing any major shifts, or are people sort of holding firm?
Yeah, I think clients are very focused on all the risks we've been talking about. They're very focused on understanding AI more as we recognize just how much of our economy's growth, how much of our stock market's growth has been driven by AI. One statistic I think that surprises me every time I see it again is that 2/3 of the GDP growth we saw over the course of this entire year in the U.S. And aggregate GDP growth has been fine. It's moving along at a decent clip. 2/3 of that growth this year came from AI specifically. It came from two categories: the building of information processing equipment and structures, which is almost definitely AI data centers and the equipment to support them, and from software development, which is quite likely to be aligned with the AI boom. And the fact that those two categories are delivering most of the growth we've seen this year really emphasizes the extent to which American investors are leaning into AI. American investors have benefited from that this year, to be very clear. But it's also clear that the aperture of risks we're exposed to, the set of different upside and downside shocks that could affect our clients, is narrowing. And there's now a pretty big bet being made on AI. And disappointments in that space are likely to be costlier than we otherwise might think. So we're focused on keeping our clients as diversified as we can in a world where the S&P 500 is a little less diversified than it was in the past. We're focusing on identifying quality companies that, regardless of the macro backdrop, are going to deliver persistent compounded returns. And we're looking for things like in the robotics space, where we expect to see new themes and new secular trends in the way investors and consumers interact with technology and the economy. And we expect to see those things continue to evolve investor and consumer preferences.
Is that concerning to you that the S&P 500 is not more diversified than it is, or it's just that's the world we live in, basically?
It's certainly a different way of thinking about the broader index, right? We all learned when we got into this business that you look at the index as a broad exposure to all facets of the economy and that diversifies away the idiosyncratic risks of holding individual names. But as you said, Gary, we live in a world where 30% of that index of the S&P 500 is 7 companies. And that means we have to think about the index in a less diversified way than it is. I do worry, particularly for end investors who don't spend all their time thinking about things like how the U.S. stock market index is composed, that there's not a wide enough appreciation of how much U.S. equity markets have become this rather undiversified bet on AI. And that's why it's important, I think, to look broadly at a suite of investments that, are focused on delivering exposure to quality companies and global markets in ways that are, diversified.
And Eric, aside from AI, what other factors should we be watching over the next 3 to 5 years? What big trends that you think will shape the global economy and markets?
Yeah, a few that I touched on before, and I'll mention a few more as well. The fiscal sustainability story, and I know it just sounds so exhaustingly boring to be droning on about the balance sheet of the U.S. government. We've been talking about this for decades. It historically hasn't been supermarket relevant because markets have been very focused on, confidence that policymakers in Washington were just going to solve the issue. And, I think their confidence has gotten a little lower over the past couple years. And we've seen that in both the end of the Biden administration and in the Trump administration, where it's clear that Washington was willing to tolerate larger and larger deficits out into the long run. Markets are starting to care now. We're seeing that in long-term interest rates markets. And it's something that, in my mind, is poised to become more acute before it becomes less acute. So that's the big one for me.
And looking at the Fed's commentary in September, the takeaways seem to be a very complex environment for them to sort of navigate, which you referenced earlier on. Given that, what's your advice, in sum to investors to navigate what's a complex environment?
My broad advice to investors is to seek real diversification, which means thinking a little bit more outside the box than just holding a broad index that today is dominated by such a concentrated bet. It's a bet that I'm positive on. I think AI is going to change the world. And I think some of that exposure is necessary, but I think investors need to think about, making sure they have access to quality companies, making sure they have access to things that aren't just the big trend of the day. And that's why we like focusing on things like I mentioned robotics a few times, the kind of new trends that are a bit downstream from the immediate AI shock. But thinking broadly about your stock market exposure and your bond market exposure in a way that that delivers real diversification.
Eric, thank you for joining us today and for sharing your perspective and valuable insights. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance. We'll see you again soon.